Welcome to Objective 5 in Unit 4 of Accounting 3310. This is the second part of our discussion on capital leases. We've already discussed the criteria to determine whether something is a capital lease. Now we're going to take a look at the accounting for capital leases. The events in the capital lease are the following. First, the initiation of the lease. At the time that the lease is initiated, the leased asset is placed on the books of the company as well as the lease obligation for the future payments. Second, as the leased asset is used, it's depreciated by the lessee. Throughout the life of the lease, we also have lease payments being made to pay for that asset. And then at the end of the lease, we'll have some kind of settlement, either returning the leased asset back to the lessor or retaining that leased asset. Let's take a look at what the accounting looks like for these events. First of all, at the lease initiation, the lessee puts on its books both the leased asset and the capital lease obligation. It's an increase in the asset of leased equipment and an increase in capital lease obligation. Let's take a basic example. Lessee company is leasing equipment from lessor company for 3 years, paying $32,000 at the beginning of the year. The implicit interest rate and lessee incremental borrowing rate is 12%. This will keep one portion of lease accounting a little simpler. This lease meets the criteria for a capital lease for both parties. Now, first thing we want to do is find out what is going to be used as the value for this leased equipment. It is in effect, an equal payment note for this equipment. There's a down payment of $32,000 paid at the time the lease begins, and then another $32,000 at 1 year from now, and another $32,000 2 years from now. So there's 3 payments, equal payments at equal intervals. The leased equipment and the capital lease obligation have the value of a present value of an annuity due of $32,000 for 3 periods at a 12% interest rate. You can calculate that in a spreadsheet using the present value function or on a financial calculator by setting it to annuity due and then entering as payment $32,000, number of periods 3, interest 12, and calculating $86,081.63. The journal entry then increases the asset and increases the liability. The second event is depreciation. Leased assets are depreciated by the lessee for the useful life to the lessee of that asset using the usual accounting method for similar assets. Technically, a leased asset is an intangible asset because the lessee has the right to use an asset rather than an asset itself. Therefore, technically, the depreciation of leased equipment is an amortization of an intangible asset. However, it really is more common for companies to report assets under capital lease along with their fixed assets and to include the amortization on these assets under capital lease with depreciation expense. Leased assets are depreciated by the lessee for the useful life, and the useful life will depend on the terms of the lease. First, if the asset is to be returned to the lessor, then the useful life is just the term of the lease. If the asset is to be kept by the lessee, either because there's a title transfer or because there's a bargain purchase, then the useful life is going to include the years beyond the lease term, the full useful life of the asset, not just that shorter period of the lease itself. Next, in order to depreciate an asset, one would have to determine the residual value, same as we do for any leased asset. If an asset is to be returned to the lessor, then the residual value is going to be any guaranteed residual value if there's been any part of the lease that requires one, or 0. If the asset is to be kept by the lessee, then the residual value is what the asset is going to be worth at the end of its useful life, and that piece of information will not be present in the lease contract. Let's find depreciation. What if we have a lease with a value of $75,000 that has a 3-year term and no expected residual value? Using straight-line depreciation, we would have 75,000 minus 0 divided by 3, or 25,000 in depreciation each period. Let's take another example. If we have a lease with a value of $76,000 that has a 3-year term and includes a bargain purchase at the end of 3 years, the asset has a 5-year useful life and a residual value of $1,000 at the end of 5 years. Then we have not the 3-year term, but the full 5-year term to depreciate this asset over, and we do have a residual value at the end of $1,000. So the depreciation is the $76,000 minus $1,000 divided by 5, or $15,000 during each year of the use of the asset. Lease payments are the payments of the required equal payments that are designated in the lease contract. This is equivalent to having an equal payment note, but it has one unique feature, that is, unlike notes in which the payments are made at the end of the period, with leases the payments are typically made at the beginning of the period. That's because it decreases the risk to the lessor to have people pay up front. I'm sure that's your experience also. If you've rented apartments, you're required to pay your rent in advance. The apartment is not going to wait until you've lived through the whole month and then hope that you will pay at the end of the month rather than skipping out. When we create this amortization table, it's going to follow all of the exact same principles that we used when we made an amortization table for a note or for a bond. The only thing that we're going to have to be careful about is that we've got this initial payment in period 0, which is the time of the initiation of the lease. That initial payment has no interest in it because no time has passed since the lease began. This is like a down payment when buying on account. Let's take a look at an amortization table. We've added the row 0 to our typical amortization table. The value at the beginning of the period is the $86,081.63 we've already calculated as the present value of an annuity due of $32,000 for 3 periods. The interest in period 0 is 0. It's interest times rate times time, but the time element is 0. It's the equivalent of a down payment. So that entire $32,000 is deducted from the value of the lease obligation. So immediately after paying that first payment, the value of the lease obligation is $54,081.63. Interest then accrues during the first period on that lower lease obligation, and here it's calculated as $6,489.80. Notice that the cash flows are equal each period in a lease, so $32,000 is what is still paid at the end of period 1, which is the beginning of period 2. That cash flow is more than the interest. Remember, we're using exactly the same principles we used previously, so that the change in the lease value is that the lease obligation has a repayment of principal of $25,510.20. That is taken off of the lease, and so all that's owed at the end of the first period, the beginning of the second period, after the second payment has been made, is $28,571.43. Interest accumulates during the second period. Notice how much less that interest is because the principal is so much less. $32,000 is still the amount paid at the beginning of the third period or the end of the second period. All of the cash flow above the interest is repayment of principal, which exactly matches the amount of principal repayment that's left. So after the third payment is made, the lease obligation is fully paid and there's no liability left. Here are our journal entries for the payments. We're going to decrease the lease obligation and pay out cash for that initial payment. There's no interest because it's the equivalent of a down payment that's paid on the day the lease is initiated. The two future payments, though, each are going to include interest expense, with the numbers taken directly from that amortization table. It's a decrease in the capital lease obligation, a recognition of interest expense, and a recognition of the cash outflow. The financial statement effects during the life of this lease is that we will see on the income statement interest expense associated with the lease debt and depreciation associated with the leased asset. Notice that the expenses in year one are more than the cash outflows. That is, if we take the depreciation on the $86,000 asset and we have the amount of interest of about $6,000, that's more than the $32,000 that's being paid. In this way, an operating lease, which would have recognized just the $32,000 as rent expense, would be a classification choice that would make net income higher than a capital lease that recognizes interest expense and depreciation expense. On the balance sheet, the capital lease obligation is included in liabilities, and it's divided up between current and long-term classifications because there will be some payment during the next period that's a current payment on a long-term lease, and then we'll have the rest of the long-term lease classified as long-term. At the end of a period, there could easily be interest payable, especially because in these lease settings, we have payments being made at the beginning of a period, and so interest will continue to accrue throughout that period. On the statement of cash flows, in year one, the capital lease will have a financing outflow of $32,000 because the entire amount of cash paid is a repayment of principal. However, in year 2 and 3, the cash outflow is divided between interest and repayment of principal, and the interest portion is a part of operating cash flows, and the principal portion is a part of financing cash flows. Interest expense is going to be related to the cash interest paid, so that we're going to be able to see the interest expense that's accrued during the period on the income statement and the amount of cash interest that's actually paid on the statement of cash flows. Depreciation expense, remember, is not going to show up on a statement of cash flows because depreciation is a non-cash expense. And the principal payments made are showing up as a cash outflow for financing. Now let's think about the last event in the life cycle of a lease, the settlement of the lease at the end of the lease. There are two possibilities. The asset could be retained by the lessee. That's going to happen if there's a title transfer or a bargain purchase. Or the asset could be returned to the lessor. So that's the other possibility. Let's take a look at these two different events, but in a relatively simple setting. If the lessee retains the asset, then the lessee must transfer the leased asset and its accumulated depreciation account to a fixed asset account and its accumulated depreciation account. That is, once we have a leased asset that we own and have title to, it's no longer a leased asset and needs to be in a different account. So that's simply reclassification. If the lessee retains the asset, there's no change in the accounting for the liability because of that. The capital lease obligation is already zero at the end of the lease, and there's no additional payments typically. In this demonstration, the asset is fully depreciated because the economic life and the lease term match, and there's no residual value. So we would have a journal entry that takes the asset from equipment under capital lease into the equipment account, and the accumulated depreciation from accumulated depreciation for equipment under capital lease, and puts it into a regular accumulated depreciation account. Now let's look at the other possibility. The lessee returns the asset. In this case, the lessee must remove the leased asset and its accumulated depreciation from its books. These two are going to match each other because if the lessee has been planning all along to return the leased asset, then the asset has been depreciated over the life of the lease. Notice that again, the capital lease obligation is already zero on the books of the two companies because it's been fully paid for. In this demonstration, the asset's fully depreciated because the economic life and the lease term match, and there's no residual value. The journal entry that's written then is simply to take the equipment and its accumulated depreciation off of our books. The equipment here has a credit entry, it's on the right-hand side, that decreases the asset. The accumulated depreciation is a contra asset account, and it has a normal credit balance, so it's decreased with a debit. Let's summarize the lease principles. Lease accounting combines the accounting for fixed assets, when to capitalize the costs of an asset, what costs to capitalize, and when and how to depreciate the fixed asset are all going to be parallel to the decisions that one makes for any other asset. It also includes the accounting for financing. One could buy any sort of asset on credit, but a lease has a particular usual format for the capital lease obligation. As with any other financing, we have to know what the appropriate discount rate is. We have to identify all of the relevant cash flows, and we have to use the effective interest method to separate out interest from principal repayments. Lease amortization tables are just a little distinctive from the amortization tables we've used for notes and for bonds. The value of the capital lease obligation is at the beginning of the lease term appears at the top of the amortization table. The interest that's used, remember, is a bit complicated. We're going to use the lower of the lessor's implicit interest rate if known, or the lessee's incremental borrowing rate. So watch in the problems for all of the information you need to select the appropriate interest rate. Then at the end of the lease term, there could be a variety of additional payments. For this class, we are not going to have amortization tables to create that have those end of lease term items in any kind of quiz or testing setting. But you can imagine that if there were a bargain purchase, that would be at the end of the lease term, or if there were a bargain renewal, or if there were some guaranteed residual value that the lessee was obligated to pay to the lessor. Those would be end of lease term payments. We now have described leases, the events in a lease, and adapted the journal entries that we understand and the amortization tables that we've done before to leases. Thank you.